Commodity Policy Part 2 will come to order. Good morning and welcome to today's hearing. This hearing is a continuation of the series we've been holding over the past month in preparation for the next Farm Bill. Over the course of the next several months, we'll be working to improve upon the 2014 Farm Bill and ensure that the needs of not only American farmers and ranchers are met, but that consumers will continue to benefit from sound and stable farm policy. Last week, we heard from producers of corn, soybeans, wheat, barley, and sorghum about what is and is not working in the 14 Farm Bill for those crops. This week, we'll have the opportunity to hear the perspective of the cotton, rice, peanut, canola, and sugar industries. As members of this committee are aware, these hearings come at a period of time when the Farm Bill is being tested, and that's exactly the period of time by which they should be judged. Commodity prices are in the tank across the board and have been for several years. Net farm income has fallen 50% in 4 years, the steepest decline since the Great Depression. It's times like these when getting farm policy right is critical for farmers and ranchers. As then Chairman Lucas was fond of saying, farm bills are not written for the good times, they are written for the bad times, as we're experiencing now. Last week, we heard the message that the farm safety net largely was working as intended and the framework should be left alone. That said, witnesses pointed out additional tweaks like improving the yields used to calculate ARC guarantees would be needed to provide a functioning safety net. While we'll hear about what is and is not working, we'll also have the opportunity to hear from a crop that was left out of the commodity title in the last Farm Bill altogether, and that is cotton. We'll hear about the effects that this lack of policy has had on the cotton industry and the ripple effect across other crops in rural communities. While committee leadership at the time warned this could happen, this provides yet another real-world example of why we need sensible farm policies in place for all major commodities. I'm glad to see that we have such an outstanding set of panelists here today. Thank you to each one of you for taking time out of your busy schedules and away from your operations to join us. Your commitment to improving farm policy for all of your fellow producers does not go unnoticed by the members of this subcommittee. With that, I'd like to yield to the ranking member, my friend Mr. Nolan from Minnesota, for any opening comments he would like to make.
Thank you very much, Chairman Crawford and members of the subcommittee for holding this second hearing with respect to commodity policy in the next Farm Bill. And thank you to the great panel of witnesses that we have here today. And I can't tell you how glad you're here, how glad we are that you're here, and anxious to hear from you. There's an old saying in this town that if you don't show up to make your case, why one of two things can happen. One is nobody knows you exist. Worse yet, they know you exist and think you don't care. So that's the last thing we want, because the other old saying in this town is that if you're not at the table, you might be on the menu, and we don't want that as well. So we're about to hear from all of you, including Mr. Rob Renning from Kennedy, Minnesota. Welcome, Rob. Good to see you here. And welcome to the subcommittee. Well, it's abundantly clear from all the numbers and studies that we have seen that economic times in America's farm country are tough, and they're getting tougher. Commodity prices and farm income are down, debts are and cash rents are going up, and loans are hard to come by, and 2017 promises to be more of the same. And we can't have that. It's also clear that we need a farm safety net that works for all farmers, regardless of which commodities that they produce. While we may not grow cotton in Minnesota, we grow a lot of corn and a lot of wheat and sunflower seeds and barley and, of course, canola, which we're going to hear about, I hope. So, but we know that when one commodity operates under a policy that doesn't work, then it affects and is felt on all other crops in all of the other regions. So this hearing serves as an opportunity for us to learn more about the unique concerns of each commodity producer for their particular crop, and hopefully today's testimony can bring us closer to consensus on what our commodity programs ought to look like in the next Farm Bill. Because the fact of the matter is that we need to do everything we can to put a stop to these boom and bust cycles that threaten our farmers, threaten our rural communities, threaten our rural businesses, and the many good-paying jobs they support all across rural America. So with that said, I'm looking forward to hearing from today's witnesses. Once again, I want to thank Chairman Crawford here for holding this important hearing. Mr. Chairman, I yield back the remainder of my time.
I thank the gentleman, and I'd like to recognize our full committee chairman, Chairman Conaway, for any opening comments he'd like to make.
Well, thanks, Chairman. Only Mr. Nolan has the market cornered on old sayings around here. 18 Farm Bill is going to be on us rapidly. What I would ask each of you, the witnesses in their policy arms, to get your good ideas in front of the committee sooner rather than later. You probably have till starting of the fourth quarter, so we need whatever ideas you have legislatively in the mix soon, so that we'll be able to fill those in. With that, I'm looking forward to the testimony, and looking forward to each of y'all's groups on crafting that 18 Farm Bill. With that, Mr. Chairman, I yield back.
I thank the chairman. I'd also like to recognize the ranking member of the full committee for any comments he'd like to make at this time.
Thank you, Mr. Chairman, and thank you for having the hearing, and thank the witnesses for being here. I'd like to welcome Mr. Ronning, who's from my district, from Hallock, Kitson County. It's not the end of the world, but you can see it from there. And he's done a great job of not only representing canola, but other crops in our area. And he was one of those that was instrumental in getting a processing plant up in Hallock for canola. We got our challenges as we work towards the next Farm Bill. And I'm one of those, even though we don't grow cotton, I'm for getting a fix for cotton. And also interested in some other areas as well in terms of seeing what we can do to make sure that the system works going into the future. So thank you for being here. Looking forward to your testimony, and yield back.
Thank you, Mr. Peterson. And the chair would request that other members submit their opening statements for the record so the witnesses may begin their testimony, and to ensure that there's ample time for questions. I'd like to welcome our witnesses to the table. First, Mr. Ronnie Lee, Chairman, National Cotton Council, Brownwood, Georgia. Mr. Blake Gerard, Chairman, USA Rice Farmers Board of Directors, Cape Girardeau, Missouri. Mr. Tim McMillan, Southern Peanut Farmers Federation, Enigma, Georgia. Mr. Rob Running, President, U.S. Canola Association, Kennedy, Minnesota, and also on behalf of the National Sunflower Association. And Mr. Jack Roney, Director of Economics and Policy Analysis, American Sugar Alliance, Arlington, Virginia. One thing I would like to point to your attention, gentlemen, I believe all of you have been here before, but if you'll notice the lights in front of you, it's just like traffic lights. When it's green, feel free, keep your foot on the gas. When it turns yellow, get ready to step on it, and when it turns red, slam on the brakes so we can get everybody in a timely fashion. I appreciate that. I'd like to first yield to Mr. Austin Scott to introduce our first witness.
Thank you, Mr. Chairman. I want to welcome Mr. Ronnie Lee, Chairman of the National Cotton Council from Brownwood, Georgia. He's a great farmer, but his real claim to fame is that his brother-in-law is a great turkey call maker, and maybe over the Easter break we can go chase some of those overgrown chickens. So, thank you.
Thank you, Mr. Scott. And Mr. Lee, you are recognized for 5 minutes.
Chairman Crawford, Ranking Member Nolan, Subcommittee members, thank you for the opportunity to testify to the policy needs of the U.S. cotton industry. My name is Ronnie Lee. My family and I raise cotton, corn, peanuts, small grains, pecans, cattle in southwest Georgia, and own and operate a cotton gin and warehouse operation. Implementation of the 2014 Farm Bill coincided with a time of significant changes in the global cotton market. Shortly after the bill was enacted, cotton prices began a steep decline. The result of policy changes in China, a buildup of global stocks, lower demand, and reduced exports. Slumping cotton demand is largely a result of tremendous increases of polyester use. Capacity is contributing to artificially low polyester prices in key Asian markets such as China. This is the global market U.S. cotton must compete in, since 75% of the raw fiber production is exported, with another 15 to 20% exported as cotton textile products. Market volatility and mounting economic pressures underscore the critical importance of an improved safety net for cotton farmers. Cotton is the only crop that does not have a long-term price or revenue protection in the Farm Bill. Current ARC PLC policies in the Farm Bill are designed to help producers withstand prolonged periods of price decline and depressed market conditions. While these policies have generally performed well for producers like myself on our other crops, I remain completely vulnerable to the instability in cotton markets. The current Farm Bill introduced fundamental changes in the cotton policy with the STAX crop insurance policy as a core component of the cotton safety net. The move to STAX was done in order to resolve a long-standing WTO case brought by Brazil. Unfortunately, the changing economic landscape and lower market prices reduced the effectiveness of STAX as a means of providing support for cotton producers. For over a year, the National Cotton Council has been working with Congress to get cottonseed designated as a covered commodity and eligible for ARC and PLC programs. We strongly believe a cottonseed policy is needed now to help provide support to our producers as a bridge until a new Farm Bill is enacted. Part of this process will be to convert generic base, which is historic cotton base, back to cottonseed or other covered commodities. The establishment of generic base was intended as a short-term measure given the circumstances of the 2014 Farm Bill development, not a long-term policy. In the next Farm Bill, for Congress to be able to address the shortcomings in the cotton policy and other areas of the budget, in other areas of need, we strongly oppose any attempts to reduce the budget. Given the dramatic decline in Farm Bill spending, coupled with significant downturn in farm income and generally weak commodity prices, a greater investment in these critical policies for rural America should be in order. For U.S. textile mills, after a decade of sharp decline, cotton consumption has stabilized since 2008. The stability and expected future growth can be attributed to the continued benefits of the Economic Adjustment Assistance Program by allowing U.S. mills to make new investments necessary to remain competitive. Continued funding of the program supports a manufacturing base that supports U.S. jobs. The National Cotton Council strongly supports additional investment in MAP and FMD trade promotion programs, the highly successful public-private partnerships that help leverage the industry funds to open and expand export markets. For the past 3 years, cotton producers have struggled with low prices and high production costs, resulting in financial hardship. It is imperative that the next Farm Bill bring back cotton to Title I so that producers are able to access the same complete set of risk management tools available to other crops. We look forward to working with Congress and other organizations to pass a Farm Bill that effectively addresses the needs of all producers of all commodities in all regions of the country. Thank you. Be pleased to respond to questions.
Thank you, Mr. Lee. I'm now pleased to welcome Mr. Blake Gerard, Chairman, USA Rice Farmers Board of Directors from Cape Girardeau, Missouri. Mr. Gerard, you are recognized for 5 minutes.
Thank you. Chairman Crawford, Ranking Member Nolan, and members of the subcommittee, thank you for holding this important hearing on commodity policies. My name is Blake Gerard, and I'm a fourth-generation family farmer and grow more than 2,000 acres of rice and soybeans in southern Illinois in Congressman Boss District. I'm the chairman of the USA Rice Farmers Board of Directors and the USA Rice Government Affairs Committee. I'm honored to offer my testimony on behalf of the USA Rice Federation. Rice is grown on 3 to 4 million acres across 8 states. The industry as a whole provides job and income for more than 128,000 people, 31,000 of those directly in farming. So while a small commodity by acreage, we pack a punch, contributing $34 billion annually to the economy, with the farming sector accounting for $5.6 billion alone. USDA's most recent forecast for 2017 prices put us at a 10-year low and a 36% decline since the 2014 Farm Bill passed. While a variety of factors have influenced this downturn, the actions of major exporting countries and their governments are the most significant. In recent years, we've seen a significant increase in imports of foreign rice, with imports coming primarily from countries that are known to violate their WTO obligations. Operating costs for rice exceed every other crop covered by the commodity title. projected by USDA to be nearly $1,000 per acre in 2018. Because of specialized infrastructure, field equipment, and soil types needed for rice, it's difficult to economically justify a shift from year to year. So we rice farmers are in it for the long haul. We intend to ride out the storm, but we could not do so without the safety net that PLC program provides. It's safe to say that one of the reasons myself and the majority of rice farming families are still in business today is the Farm Bill's safety net, specifically PLC. 99% of long grain acreage and 94% of medium grain farms selected PLC. It has provided countercyclical assistance when needed the most. While we feel that PLC was working the way Congress intended, we have recommendations we believe which can make it more effective for rice farmers. We recommend that you consider revisions that would accelerate the delivery. PLC assistance is triggered based on the previous marketing year average, which is calculated and published by USDA more than 12 months after we've harvested our crop. The bills for our input costs don't wait 12 months before coming due. When farmers go to the bank to renew operating lines of credit, it's nearly impossible to predict a year in advance what assistance they may receive. This seriously impacts our ability to forecast a cash flow sufficient to obtain operating financing. California's rice market has fallen at a more rapid rate than the rest of the country, but they have not received the much-needed assistance that PLC could provide. We appreciate inclusion of the multiplier for temperate japonica rice to take into account the higher-than-average cost of production in California. The multiplier currently used to calculate the reference price does not reflect the full cost of production and therefore needs to be increased. The statute and regulations that define actively engaged in farming for the purpose of program eligibility also remain problematic for rice farmers. These regulations impose an arbitrary cap of 3 managers per operation, regardless of the size or complexity. USDA's final rule did not protect entities from maintaining family farm status following the death of a lineal family member, such as a parent or grandparent, which has resulted in the disqualification of true family members who have an active role in the operation's survival. We request that this committee revise the statute to provide an exemption within those regulations to protect farm families against unforeseen linkage breaks in their operating structure. Additionally, a $125,000 payment limit seemed like a far-fetched problem when the prices were high in 2013 and 2014. Unfortunately, as market conditions continue to deteriorate, growers are receiving larger payments, and many are close to or at payment limits. It seems wrong to maintain policy that provides full assistance to producers when they experience some losses, but only partial assistance when they really are hit the hardest. Mr. Chairman, farmers face more risk than any other business. We're dependent on global markets that are often distorted. Weather, disease, and any number of other factors could cause our crops to fail and us to go bankrupt. When threats are made to cut funding and policy for the farm safety net, the existence of the full-time family farmer is put into jeopardy. Without a strong domestic support structure, only a small number of truly consolidated operations could survive. I'm here to ask this committee's consideration in not only maintaining our commodity title programs, but strengthening it using our recommendations as you work to reauthorize this important legislation in 2018. Thank you, and I'll be happy to respond to questions.
Thank you, sir. Appreciate that. I want to yield to the gentleman from Georgia, Mr. Austin Scott, to introduce our next witness.
Thank you, Mr. Chairman. We have Mr. Tim McMillan, representing the Southern Peanut Farmers Federation from Enigma, Georgia. And if you don't know where Enigma, Georgia is, that's in Berrien County, Georgia. And if you don't know where that is, we're capable of governing ourselves.
I thank the gentleman, and Mr. Tim McMillan, you are recognized for 5 minutes.
Good morning, Chairman Crawford, Ranking Member Nolan, and members of the subcommittee. I am Tim McMillan, and I'm a 7th-generation family farmer from Berrien County, Georgia. That's on the other end, Congressman Peterson of the world. I am testifying today on behalf of the Southern Peanut Farmers Federation, the largest peanut grower organization in the United States. I want to be clear today that the peanut provisions of the 2014 Farm Bill have provided a safety net for peanut producers. If the price loss program had not been in place, I'm afraid many farms in the Southeast would no longer exist because of the downturn in the farm economy. which has plagued us the past 3 years. The Federation supports maintaining the current PLC program in 2014 Farm Bill, including these key provisions: the current reference price for peanuts, a separate payment limit as established in the 2002 Farm Bill, and storage and handling provisions. The 2014 Farm Bill was drafted during a period of high prices. When we compare average prices in 2011 through 2012 to 2016 prices, we see a 39% decline in peanut prices. The USDA has projected the net farm income from 2013 through 17 to decline by 49.6%. I see the real impact of these numbers in the faces of my neighbors, my customers, and I hear it in discussions with lenders and our suppliers. The Peanut Price Loss Coverage Program has worked, but peanuts are not sufficient to carry an entire farming operation. Corn and cotton prices have been depressed, and with a lack of a cotton PLC program, more pressure has been placed on growers to plant peanuts by lenders and others. Peanut growers know that a rotation is critical for their cropping system. However, during this period of severely depressed farm economy, many farmers modified their crop rotations in order to survive. As a result, U.S. peanut yield has declined by approximately 13%. Although the increased peanut acreage has impacted yields and the cost of production, peanut acreage during the life of the 2014 Farm Bill is not out of line. During the life of the 2014 Farm Bill, average planted acres were only 16% more than the average acres planted during the years 2002 through 2013. What about the demand for peanuts? Demand has kept pace with the supply of peanuts. U.S. per capita peanut consumption increased 12% from 2012 to 2016. Domestic demand and export demand have grown significantly in the last few years. The number of peanuts used for peanut butter has grown 64.4% since 2002 and 10% since 2014. When we take a closer look at the USDA's Foreign Agricultural Services export data, comparing the average exports of peanuts and peanut butter during the 2008 Farm Bill relative to the 2014 Farm Bill, we also see strong growth. Peanut exports increased by approximately 71%. What about the supply of peanuts in the U.S.? In the current market, demand exceeds supply. Given this economic situation, early contract prices for the 2017 crop have been reported in the $475 to $550 per ton range. In addition, peanuts have not seen significant forfeitures at USDA. Marketplace indicators suggest there is not an oversupply of peanuts. According to the National Center for Peanut Competitiveness, the peanut program in the 2014 Farm Bill has not led to excessive peanut acreage. What about the impact of generic acres on peanuts? Generic base acres are available to any covered commodity in 2014 Farm Bill. The committee wisely established a program allowing growers to keep these base acres. Without these base acres, the current struggling farm economy would be much worse. In conclusion, the Federation supports the peanut provisions in the 2014 Farm Bill and appreciates the opportunity to work with you as we move forward with the next Farm Bill. Thank you for allowing me to testify today.
Thank you, Mr. McMillan. I'd like to recognize Mr. Peterson, Ranking Member, for introduction of our next witness.
Well, I kind of introduced him before, but Ron Running is one of my constituents. He does a great job, not only as a farmer, but spending a lot of his time representing people in our part of the world at meetings like this, and so I personally appreciate his involvement and efforts, and I don't know how he gets time to farm, but other than that, welcome to the committee.
My brother wonders the same thing at times.
Mr. Running, you are recognized for 5 minutes.
Thank you, Mr. Chairman. On behalf of the U.S. Canola and National Sunflower Associations, I want to thank the Chairman and Ranking Member, as well as the committee, for the invitation to appear before you today. I am Robert Running, President of the U.S. Canola Association. My brother, nephew, and I farm in the very northwest corner of Minnesota, just a few miles south of the Canadian line, growing canola, barley, wheat, and soybeans. Because minor oilseed producers grow a number of crops in rotation on their farms, I want to note the common areas of agreement between USCA and NSA, and have with groups affiliated with the statement attached to my testimony. We also signed a letter to the Senate Budget and Appropriations Committee with 15 other farm groups outlining in detail the need for additional resources to write the next farm bill. U.S. has planted an average of 1.7 million acres of canola and 1.7 million acres of sunflowers over the past 5 years. The majority of U.S. canola production is in the northern plains. However, winter canola varieties have been successfully introduced into the southern Great Plains, and this region has the potential to become another major U.S. production area. Another winter canola production region can also be found in the mid-southern states, with much of this acreage being double cropped with soybeans. Pacific Northwest also grows both winter and spring canola varieties. U.S. produced a record 3 billion pounds of canola seed last year, but it will still need to import 68% of our expected canola oil consumption and 75% of our expected canola meal consumption this year. The majority of the 2.5 billion pounds of sunflower seed the U.S. produces annually are grown from the Dakotas to the panhandle of Texas. There are 2 types of sunflowers grown. Oil sunflowers comprise 80% of the production and are grown for high-quality cooking oil or sold as bird food. The remainder is confection seed, which is used in the snack food and bakery markets. Confections receive a premium over oil, causing this season average price of all sunflowers to be higher than other minor oil seeds. 75% of the U.S. sunflower oil is consumed domestically, with the remainder exported to Canada, Mexico, and Japan. Confections are very reliant on exports, since 1/2 of our confection production is exported, mainly to Spain, Mexico, Canada, and the Middle East. USDA and NSA support continuing the ARC and PLC programs, with support payments tied to historical crop bases and ability to choose between programs by crop. We also encourage the use of RMA yields first rather than NAS yields when computing ARC County yields. In the 2014 Farm Bill sign-up, 97% of canola base acres were entered into PLC program. Sunflowers base sign-up was more diverse, with 56% into PLC and 43% into ARC County. Prices for other crops have fallen, for both crops have fallen 40% from their peak, and both have received payments in the 2014 Farm Bill. Although sunflower payments have been less due to the confection seed premiums, which increase all sunflower season price. However, for the 2016 crop, confection premiums have declined considerably, and payments for PLC and ARC County are expected to increase. Although annual planted acres appear stable for canola and sunflowers, there is real concern that core acreage will not be sufficient in the future to sustain infrastructure for those alternative crops. Many producers in the northern plains who plant canola and sunflowers have also begun planting soybeans and corn. Per acre cost of seeding canola is $50 more and sunflowers $20 more than soybeans this spring. And soybean acres will increase this year as farmers strive to reduce the overall input costs. Sunflower producers in the prairie pothole region also have the added burden of potential blackbird depredation that can lose a substantial portion of their crop in the fall if large migratory flocks infest their fields. Beyond the healthy oil both these crops supply, as well as the high-quality canola meal used to supplement dairy herd rations, canola and sunflowers also provide needed quality habitat for honeybees as well as wild pollinators. Honeybees support $15 billion of agricultural production in the U.S. through pollinator services, but a major decline in honeybee health this past has put these benefits at risk. Bee health declined. It has been linked to several factors, including the lack of suitable habitat due to increased agricultural monocultures and declining wild spaces. Canola and sunflowers provide ideal habitat and forage for honeybees when they are not being used for pollinator services and are preferred hive sites by beekeepers. Canola fields bloom a month longer under ideal weather conditions, or longer under ideal weather, providing bees with a good source of nectar and pollen. Sunflowers bloom in late summer, providing habitat and forage at a time when fewer plants are blossoming. Maintaining the acreage of cropland planted annually to these two crops is essential to contribute viably to the honeybee industry. An increase of just 2 to 3 million acres across the U.S. would have an immediate positive impact on honeybee health. USDA and NSA support the creation of pollinator incentive, include canola and sunflowers in cropping rotations to provide habitat for honeybees and wild pollinators. We are uncertain whether this initiative would be in the commodity title or conservation title, but are willing to work with the committee to develop such an initiative. Thank you, Mr. Chairman, for your time and attention. I'll be happy to answer any questions the committee may have.
Thank you, Mr. Running. And now recognize Mr. Jack Roney, Director of Economics and Policy Analysis, American Sugar Alliance. You're recognized for 5 minutes.
Thank you, Mr. Chairman and Mr. Nolan, members of the committee. I'm Jack Roney, economist for the American Sugar Alliance. The ASA is the national coalition of sugar beet and sugarcane growers, processors, and refiners. The U.S. sugar-producing industry generates 142,000 jobs in 22 states and $20 billion per year in economic activity. I would like to summarize my written testimony today by describing why we have a sugar policy and how it's working. The U.S. is the world's 5th largest sugar producer and among the world's most efficient. If we are so efficient, then why do we need a U.S. sugar policy? The answer is in the tremendous distortion in the so-called world sugar market. This chart tracks the world average costs of producing sugar over the past 3 decades. The cost has averaged 19 cents per pound over those years. If I added the world average sugar prices to this chart, what would you expect? Certainly, we would expect prices to average above the cost of production, high enough to keep producers in business. But here's the reality. The so-called world price, the red line, has averaged just 13 cents, almost always well below production costs. The 28-year average production cost is nearly 50% higher than the average price. With prices so far below cost, how can any sugar producer survive? The answer is in the domestic markets where most sugar is produced and sold. Governments maintain much higher prices than the world price so that their farmers can stay in business. Only about a quarter of sugar is sold at the world dump price. The remaining 3/4 is sold at much higher levels in the countries where the sugar is produced. Foreign governments subsidize their producers so generously they tend to overproduce. To bolster prices in their domestic markets, these governments export their surpluses. That shifts their domestic surplus problem onto the world market. Absent subsidies for inefficient foreign producers, the world price would rise to reflect the cost of producing sugar. That is why we support the resolution introduced recently by Congressman Yoho of the Ag Committee. This zero-for-zero approach says that the U.S. will eliminate its sugar policy when foreign countries eliminate theirs. We are ready, willing, and able to compete on a level playing field free of government intervention. But to give up U.S. sugar policy without any concessions from foreign subsidizers would be economic suicide for American sugar farmers. Unilateral disarmament is the antithesis of free trade, sending good American jobs to countries still subsidizing. American sugar policy is working well for American consumers and taxpayers. American consumers' prices for sugar are among the lowest in the world, the red bar on this chart. Global average retail sugar prices, the green bar, are 20% higher than U.S. prices. Developed country retail prices, the yellow bar, are almost 30% higher than U.S. prices. American consumers get a great deal on sugar that is high quality, safe, reliable, and responsibly produced. American taxpayers get a great deal too. As instructed by Congress, U.S. sugar policy has run at zero cost to taxpayers for 14 of the past 15 years and is projected to remain zero cost. The only exception was 2013, when massive volumes of subsidized dumped sugar from Mexico depressed our market and made it impossible for some producers to repay their operating loans. USDA projects zero cost for sugar policy over the next 10 years. The CBO projects some possible cost several years from now, but this is based on the assumption that Mexico is allowed to resume dumping. Mexican dumping poses the greatest challenge to sustaining a no-cost sugar policy. After Mexico's dumping in 2013, the USITC unanimously found that Mexico had injured the U.S. industry. The Department of Commerce calculated subsidy and dumping margins that totaled more than 80%. Rather than imposing those huge duties, the Mexican and U.S. governments negotiated suspension agreements in late 2014. These were intended to allow continued sugar trade without Mexican dumping. But the suspension agreements have not been successful, and American producers are still hurting. The two governments are negotiating improvements. We support these efforts, but if they are not successful, we support the imposition of duties on subsidized dumped Mexican sugar. American sugar producers have had to endure flat pricing for their sugar for most of the past 3 decades. In real terms, corrected for inflation, prices are down 43% since 1985. We have lost more than half of our beet and cane mills, 57 closures in all. The most recent casualties, Mexican dumping has driven Hawaii out of sugarcane after nearly 2 centuries of high-yielding production, and a Wyoming beet mill will close permanently later this year. The remaining sugar producers will have a chance to survive only if, 1, U.S. can implement an adequate response to Mexican dumping, and 2, the next Farm Bill contains a sugar policy that provides a strong economic safety net. Thank you for your attention and your support for American sugar beet and sugarcane farmers.
Thank you. I'd like to thank the entire panel for your succinct remarks right on time. I appreciate that. The chair would like to remind members that they will be recognized for questioning in order of seniority for members who were here at the start of the hearing. After that, members will be recognized in order of arrival. I appreciate the members' understanding. I'd like to start with recognizing the chairman of the full committee, Mr. Conway, if you have any questions. All right. I'll recognize myself for 5 minutes then. In general, to anybody that wants to respond, if low prices persist, will ARC and PLC in their current forms be a sufficient safety net? And I'll start with you, Mr. Lee.
I think so, but with some adjustments. But for cotton, you know, we're not there, so
Right.
we need to be there.
Sure. Mr. Gerard?
As the PLC currently stands with us, our reference price where it is, especially if we could accelerate payments a bit, a portion of the payment a bit, PLC works for rice as is, definitely.
Okay.
Thank you.
Mr. McMillan?
I think with peanuts, we are, we would like to keep the same program that we have now, and that would be sufficient. But we need some companion crops that we can grow, because with peanuts, we have to rotate those crops. And so we need, a companion crop like cotton that would have a safety net.
All right. Mr. Running?
Yeah, I believe for both canola and sunflowers, the current framework is very workable and is a good framework. Both organizations are quite happy with the main framework. Just some tweaking here and there.
Sure. Mr. Roney?
The sugar beet and sugarcane farmers are ineligible for ARC or PLC programs because of the fact that it's our processors who put the sugar under loan. What we need to do is retain our safety net through the non-recourse loan, and we can maintain no-cost operation of that program, assuming that we can resolve the Mexico dumping problem.
Okay, thank you. Mr. Gerard, rice producers overwhelmingly elected into PLC, and I've heard from many farmers in my state that in the absence of that policy, a lot of them wouldn't be farming today. In fact, you mentioned one of the little problems that we have with PLC is the delay, and that may be one of the tweaks that we look at. But can you explain why PLC was the program of choice for rice producers?
Yes, sir, Mr. Chairman. PLC works for rice because it's the reference price is a known number. It's something we can bank on. The timing is an issue, but beyond that, we have something that we can take to our lender and show that we do have a true safety net. We don't need a subsidy when the markets can produce. We can produce a profit, but when we're much below cost of production, we need a safety net that kicks in, and PLC has worked for us.
Is ARC workable at all for rice, in your opinion?
The problem that I see is if typical with general commodities, we're seeing it happen right now. We get into extended periods of overproduction, global glut, and extended period of low prices. So if we're looking back at an average history of average prices, an average price of $10 rice ends up to a zero safety net.
Sure.
That's the biggest problem that we've got with it.
Understood. I now recognize Ranking Member Mr. Nolan for 5 minutes.
Thank you, Mr. Chairman. I just have one question, and I'll give my colleagues here. But it's what I'd like to ask of each of you, if you would please respond. There's a significant group here within the Congress that would like to see the Farm Bill separated from the Food and Nutrition Bill when it comes up for consideration before the Congress. And historically, we've had a strong tradition of the producers and the consumers joining together. and making it possible for us to pass a good bill for both the consumers and the producers. I'd be curious if each of you could just real quickly, in the remainder of my time, share with the committee your thoughts on whether or not that's a good idea. Start with Mr. Lee.
Well, that's a good question. I can see both sides, but the SNAP program, there is a positive side there for ag and commodities. I think my main thought is that we've got to be able to pass a farm bill, and I don't know that we could do it without being together. And but I do understand that as a grower and where I am, that you wonder why sometimes. But I do know that would be difficult.
Yeah. Mr. Gerard?
As Mr. Lee stated, the representation of agriculture in the United States is dwindling and has been over the years, and the ability to pass a farm bill on its own has concerns, and we just trust your judgment in how to get the final bill completed. Thank you.
Yeah. Well, now the McMillans are big in Minnesota. You know, they own the world's largest private corporation, Cargill.
I'll have to check into that to see if they're kinfolks or not.
I want to check into that.
I would not be for separating the two out. I think they should go in together. I think this is a national security issue with our food, and I think we need to start from the farm and go all the way to consumer with this farm bill.
Thank you. Mr. Running?
Yeah, but both organizations I'm here to speak for both agree that this should be kept together, and that is a smart policy approach. Personally, I think it's a must. I think we have to keep, this will be the fourth farm bill I've been involved with, and I know how critical that is to keep the two together.
Mr. Rooney?
Mr. Nolan, we feel very strongly in the sugar industry that we've got to keep those two aspects of the farm bill together. Sugar, or rather, American farmers represent, only about 2% of the population now. And that coalition with the food consumers is absolutely critical, I believe, to maintaining a strong U.S. agricultural policy.
Well, in the remainder of my time, I want to thank each of you for your candor on that critically important issue here. And then please forgive me. I will be reading the remainder of your testimony and the questions. I have another committee meeting at this moment, so I'm going to have to leave. But thank you for being here, and thank you for your very good and candid testimony. I yield the balance of my time.
I thank the gentleman from Minnesota. Appreciate you being here, and recognize the distinguished Chairman Emeritus from Oklahoma, Mr. Lucas, for 5 minutes.
At least you didn't refer to me as the old guy, Mr. Chairman. I appreciate that. And I want to express my appreciation to the panel, not only in your straightforward testimony today, but in the assistance in putting the 2012 that became the 2013 that became the 2014 Farm Bill together. Those of you at the table and your predecessors who worked in that spirit that the committee did, that strange concept that all commodities in all regions all had to have a safety net together. That proved to be a bit more of a challenge than I would have expected the last time, but at least this time we have a framework to work through. Now, Mr. Lee, you and my cotton friends, you have a special set of circumstances, and we should never forget that this pressure that cotton was under, and this committee was under, because of a WTO case at the time the previous Farm Bill was put together, made us do some things that perhaps we were more hopeful about than has panned out. But I do believe the committee at the time tried to provide a parachute, so to speak, if we got into a real jam, and we had difficulties with the previous administration in getting that implemented. So I'm more optimistic now with the changes that face us. But just as the panel has reinforced the point about nutrition and production from the farm to the consumer, those of you who are involved in your groups, let's discuss for just a moment how important it is that all commodity groups work together. and you have relationships and conversations, and many of you farm a variety of things. We had difficulty last time. Do you have the spirit, the feel when you talk to your colleagues now that everyone understands we have to be on the same page this time, with commodity prices generally being half what they were 2 years ago? As to whoever would like to touch that.
And I appreciate those comments. I understand what you're talking about. I'm a cotton farmer, but I'm also peanut, corn. I mean, I grow most of the commodities. I don't grow rice and canola, but I really feel good, I think, about where we are today. And, hopefully we've got the case behind us, and looking at a new farm bill. I think if we can figure out how to get cotton to Title I, I think we'll all be together. I feel that way. I may be wrong, but to get a good farm bill, I think we've got to be together.
And wouldn't you say, gentlemen, that it's important that the concept of choice be maintained? I mean, we've discussed briefly here ARC versus PLC. Everyone's crop, everyone's farm, everyone's region's a little different, but it's important that we have that ability to pick what is in our best interest. And with the new farm bill, obviously I would assume we'll reset the clock and everybody can make a choice again. Isn't that a fundamentally important principle? Just whoever would care to speak.
Yeah, I think that's very clear in the policy discussions in U.S. canola, and I've been involved somewhat with national barley growers. I think that's a very critical portion of this is maintaining the choice. And going back to it's a farm bill for everyone, all farmers across the country. And we understand the purview of this committee and the difficulty in coming up with something that fits everyone and understand that.
One last question, and whoever would care to touch it. As circumstances have changed in this crop year and last crop year rather dramatically, most of it beyond the control of the producer, tell me what you and your folks back home are saying about the availability of credit to put this next crop in or to be prepared for the coming year. Is it getting tighter? Is it getting more complicated? Is it getting more expensive?
I could take a crack at that. Sugar prices are down 50% since 2011, and I think that bankers are looking with great concern at our ability to maintain a safety net. And that becomes critical, I believe, for our bankers to see some sense that there is at least a safety net for our farmers. So I think it is an enormous concern going forward, and I think it's extremely important that the commodity groups stay together on this to sustain as strong a safety net as we can manage.
Just a quick note, we just had our meeting with our banker, and he informed us that it's taking them double the time to review their notes and to go through it with farmers and explain things. And there are some that are being refused. And yes, it's a critical period right now.
So that just adds to the importance of making improvements in this farm bill and continuing to have a safety net. With that, Mr. Chairman, I yield back.
I thank the gentleman and recognize the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Mr. Chairman. I want to direct my question to two big crop issues, cotton and peanuts. But first, let's go to cotton, Mr. Lee. Last year and a little beyond, we worked very feverishly with you in terms of the cottonseed oil issue. And under the leadership of this committee and Chairman Conaway, we found a fix. And I want to know if this fix is the way we need to go. And my understanding of this fix is to designate cottonseed as other oilseed so that it is available for both PLC and ARC. Is that correct? So that it would be somewhat budget neutral by using generic base acres.
Yes, sir. There's two trains of thought there, I guess. The Cotton Council has a proposal to to designate cottonseed as another oilseed as a administrative fix is what we talked about to start with. But now we think that we have a plan, the council has a plan to through appropriations, have an opportunity to convert generic base to cottonseed base, and you'd have the opportunity, you could either convert cottonseed base or other commodities.
So I only have
I might not have,
5 minutes, and I want to get to peanuts. What I'm after is, Georgia is the #2 state in cotton production,
right.
second only to the great state of Texas. So what I want to know is, what do you, in a short sentence, what is it that you need us on this committee to do in the next farm bill to make the cotton folks happy?
Okay, we feel that that to get back in Title I, that this committee needs, we have a plan to try to get back into Title I before the new farm bill, but so that we can be at the table in the new farm bill and have a baseline.
And to get back into Title I, what must we do?
We must,
The committee, us, the committee. Yeah.
we need to convert generic base back to a cottonseed base, because it was a cotton base.
Yeah.
Now, we have a plan to convert that and have the opportunity to also convert generic base to other commodities too.
Okay.
But,
Okay.
and I'm not really answering that right.
Well, that's okay. You know that I had an old professor to tell me one time, sometimes it is not the right answer that matters, but it is the right question that is asked.
Yeah.
So we will move to make sure we make you happy.
Let me say, we just need you to work with the National Cotton Council and any proposal that we have to get back into Title I.
Yeah, because you all need. Now to peanuts right quick, Mr. McMillan, and I must say at the very beginning, when the name Enigma came up, I immediately called to mind one of the most famous Georgia legislators that made that name. And I believe his name was Bobby Rowan.
That is correct. Mr. Bobby Rowan, that's correct. He ran for governor one time.
Yes, he did.
Yes, sir.
I served with him for 28 years in the Georgia legislature, 8 in the House and 20 in the Senate. But let me get to my problem. I want you to comment on that crop rotation situation and tell us, as far as the peanut marketplace, what has been the impact of the 2014 Farm Bill on the peanut industry?
Without the 2014 Farm Bill, the peanut provisions, I wouldn't be in business today. It's been the, I'm going to say, bright spot on our farm is the peanut program. Now, it's not a great program, it's just the best program alternative we have, and that's part of the problem, is we don't have any alternatives in the area that I live other than grow peanuts, and we've been forced to plant peanuts and get out of our rotation just to be able to try to survive.
Mm-hmm. Thank you.
Thank the gentleman, and we're going to continue with Mr. Scott in Georgia for 5 minutes.
Thank you, Mr. Chairman. Mr. McMillan, I want to continue down that path. And just what percentage of the U.S. peanut production do the growers in the Federation states represent?
80%.
80%. And do the shellers support your Farm Bill position and the buying points support it as well?
Yes, the Buying Points Association and the Sheller Association is in agreement with us. In fact, I've never seen the peanut industry so unified.
I heard what you said about the lack of a safety net for other crops, leading to potentially more peanuts being planted than normally would be. Do you believe that the $530 a ton reference price is the reason for the additional acreage being planted, or do you think it's the lack of options that are available for the farmer?
Congressman Scott, you're on to something there. We do not have many options. But when a farmer makes his planning decision, he's looking at several things. He's looking at the market, he's looking at his rotation, he's looking at the farm program, he's looking at the cost of production. So that farmer, he's looking at several factors when he makes his planning decisions.
He's also, in many cases, having to negotiate with his banker on what he's going to
That is correct.
plan as well. And do you believe that we have too many peanut acres in the marketplace today?
No, we do not. The demand and supply is in balance. We have about 800,000 tons of excess peanuts, which really is not excess. That's just a 90-day supply that carries us over into the next year. That is healthy. That's where we need to be for all parts of the industry. And so we do not plant based on strictly on the farm policy. It's market and the demand and supply is in good shape right now.
Mr. Lee, Mr. Lucas talked a little bit about stacks and the design and the implementation of it. It was initially designed by the National Cotton Council, but changes were made from that original design during the 2014 Farm Bill and putting it together. Can you briefly explain those changes that were made and what effect they had on this crop insurance policy?
Yes, due to the case with WTO in Brazil that had been ongoing, the Cotton Council decided that we could do, the only option we had was crop insurance, so we came up with stacks, crop insurance, and to get us a safety net for cotton. The problem was that in the process, we would have had 95% coverage and a reference price in the crop insurance. And in the process, we wound up with 90% and no reference price. So we didn't have any coverage for a longer-term downturn in the market. So basically, it has not worked. We've not had, I think we're at 25% use of people taking stacks because it's just not, with the low market, it doesn't pay. So that was our only option at that time. And now we have that behind us, and we need to find a way that we think we can get seed back into Title I.
If I could, Mr. Lee, I've heard a lot of people express, a lot of cotton growers that they don't feel like it's worth paying the premium for.
That's right.
The coverage. Up here, many people would say, well, why don't they just change and plant a different crop? People from the metropolitan area. And so just briefly, in about 30 seconds, can you explain why cotton producers don't just switch planting to another crop and the impact on all of the businesses, warehouse generers through the area?
First of all, we have a great infrastructure. As Steve said, we need, Mike, we need rotation, number one. But we have infrastructure. Cotton pickers are $700,000 apiece, gins, warehouses. It's a huge infrastructure, and it has a large ripple effect in the rural economy. And cotton is, we just need cotton in the mix.
Mr. Lee, thank you. My time's expired, but I'd just like to remind the chairman, as you know, if you don't like being dependent on foreign oil, wait till you're dependent on foreign sources of food. With that, I yield the remainder of my time.
Amen. I recognize the gentleman from Arizona, Mr. O'Halloran, for 5 minutes.
Thank you, Mr. Chairman. Mr. Lee, I have a couple of questions. The first one deals with as I read here, for the programs, well, I didn't read it right. For the intended objectives of this program, the Cotton Competitiveness Program, to be met, USDA needs to take steps to update the key price data being used. And then you go on to state, if USDA continues to resist this administrative adjustment, then we will seek to make the modifications in the next Farm Bill. Why is there resistance for this adjustment? You had indicated in your written testimony about the ELS Cotton Competitiveness Program. And for the intended objectives of this program to be met, USDA needs to take steps to update the key price data being used. If USDA continues to resist this administrative adjustment, then we will seek to make the modifications in the next Farm Bill. So what is the resistance by the USDA on making the adjustment?
I think that's to do with the price of Pima ELS cotton and the support. It's the market is much higher than the upland cotton. And I don't think it's on a level playing field as it stands, and we need to be competitive there. With that grade of cotton is grown in other countries as well. We need to be competitive.
And so, you mentioned though that they are resistant in doing that. Why are they resistant in doing that? USDA.
I can't. Oh, well, they don't recognize China as an exporter of ELS cotton, and that's part of it. It's a little bit complicated.
Okay, thank you.
I'm an upland grower, sir.
Okay. You mentioned that returns on other crops have decreased, and that's leading to increased cotton acres. What crops were you referring to?
I don't know why I'm having a hard time understanding you. Say that again.
You mentioned either during your testimony or in written statements that returns on other crops have decreased, and that's leading to increased cotton acres. What crops were you referring to that have been decreased?
Have increased?
Decreased.
We've increased peanuts. We've decreased corn, soybeans, wheat. I don't really follow that.
Okay.
That question, sir. I'm sorry.
No problem. For any of the witnesses, now that we're entering the fourth year of the 2014 Farm Bill, can you describe how it has affected the rural economy in general? Do you see any differences as compared to the 2008 and previous Farm Bills? Anybody can take that question.
Mr. O'Halloran, speaking for the sugar industry, we've seen one profound change, and that is that Hawaii has gone out of sugarcane production after producing sugar for about 170 years. And that was the direct result of Mexican dumping into our market. And by the same token, all our producers are struggling. Our wholesale refined beet sugar prices are off 50% over the last several years. And we have a beet mill in Wyoming that will be closing this year. Many of our younger farmers are having trouble being able to stay afloat, being able to get sufficient credit to stay in business. So there's a great amount of vulnerability in our industry for both beet and cane farmers.
Thank you. And given my time, Mr. Chairman, I would like to just make a quick statement that I'm very concerned about this farm bill as it relates to the ability of our farmers and growers to be able to compete against dumping and the other pricing mechanisms that other countries are using. And I yield.
I thank the gentleman. I recognize the gentleman from Illinois for 5 minutes, Mr. Boston.
Thank you, Mr. Chairman. And my question is for Mr. Gerard, if you would. First off, let me start before I ask this question because I know you're familiar of my background and where I come from, being just adjacent, living just adjacent, but farming in my district. You're familiar with, I came from a trucking background. And in that trucking background, I had the blessing of whenever I ran the business of having my father, my grandfather. It was truly a family business. It was also my uncle, and now my brother actually runs that business. I was in that business for 10 years. I loved it for 8. But I didn't realize until your testimony, you know, I mean, each one of us try to catch up, and each time we're finding out something new if we weren't here for the writing of the farm bill that we're under now. Can you kind of expand on, because you said something and two of us were caught off guard. Can you expand on the concerns that the producers are having with the actively engaged regulations? Okay, because when a lot of people said, all of a sudden a member of the family dies, you lose them, now all of a sudden the rules change. Can you expand on that? And then can you describe how important it is that we correct this as we move forward in the new farm bill?
Yeah, this is a very critical topic. I'll lay out an example that I can understand. It's pretty simple. If we've got, for example, 2 brothers that are farming and they both have 2 children, and that's one big family partnership operation. So there's 6 people involved. In the middle of the cropping year, in the middle of July, one of the brothers passes away. That family, that farming operation loses 3 payment limitations that moment. So it adds misery to grief at that point in time. So they've structured their whole operation revolving around this, and without intention, their operation is lost $375,000 payment limitation. And that's an issue. You can't plan financial planning, and it's a disaster.
So the next question would be then, the language that is produced, that we produce in the next farm bill, should say some kind of stipulation based on when you first applied, and then it should cycle through based on that, correct?
I agree with you completely, yes, sir.
Okay. All right, that's a concern that many of us, like I said, when you mentioned it in your testimony, there were 3 of us that were sitting here, and it never clicked that, you know, the tragedy could happen to lose a family member for whatever reason, and then all of a sudden those agreements become null and void. Or not null and void, but really knock you for a loop.
Right, right.
And, Mr. Chairman, I have no other questions. I yield back.
Gentleman yields. Recognize the gentlelady from Delaware, Ms. Blunt Rochester, for 5 minutes.
Thank you, Mr. Chairman, and thank the panel. I'm torn because I have 2 questions, and I know it will take up too much time, so I'm just going to plant a seed, no pun intended. The first, really what I want to ask about is young farmers, and particularly some of the challenges in terms of credit and high land prices. But the question I'm going to ask first is one I asked last week, which I think applies to all commodities. And last week I asked about, you know, one of the biggest challenges that we hear for farmers and also the ag economy in general is about market volatility. Did the 2014 Farm Bill, the programs that were enacted, how did they react to price variation? Did the farm programs and crop insurance smooth price volatility for your commodities? And that's for the whole panel.
Representative, if it's okay, I'd like to address the young person. Is that be okay?
Sure.
Because it's very passionate, and I appreciate that question. I think it's a concern we've had really for decades, getting young people back into farming, because we don't need to lose a generation of farmers. Reason it's so passionate for me, and one reason I'm here today, is I have a 20-year-old son who is at the University of Georgia majoring in agriculture. Wow. But I'm also very anxious. I want him to come back to the farm, but I'm anxious about that because equipment cost, land cost, the problems we're having with labor now. I'm very concerned of whether he will be able to make it or not. And I know if he didn't have an uncle and a daddy that he could come back to, it'd be almost impossible. And, you know, I think the only way that he's going to be able to make it is by us giving him a hand up.
Gotcha, gotcha. Anyone else on either one of those questions?
Yeah, I think it's a major factor in agriculture is that the established generation has to help out the coming up generation. And sometimes it just becomes too difficult, and that's where you get back to the first question. And taking out some of the volatility is of course a major job of a farm bill. I believe anyway. And I think ARC and crop insurance are susceptible a little bit to a long run of lower prices, whereas PLC helps establish a more permanent base, but they both serve their function and serve it well.
Great, thank you. Anyone else?
Congresswoman, from the point of view of the sugar producers, I think the 2014 Farm Bill provided an excellent safety net program, but we were just overwhelmed by subsidized sugar from Mexico. So I think sustaining a program very much like what we have will work and will smooth out that volatility as long as in another venue we can negotiate a better arrangement with Mexico.
Thank you. I go back to the young farmer. I had an opportunity to have a roundtable with farmers in our state, in Delaware, and it was one of the issues that I think most people really were concerned about. And as you mentioned, Mr. McMillan, for their families, for their future, and it's one of the reasons I'm glad to be on this committee. So thank you so much for your time. I yield back.
Gentlelady yields. Recognize the gentleman from Florida, Dr. Dunn, for 5 minutes.
Thank you very much, Mr. Chairman, and thank you, gentlemen, for being here and helping us with this. My first question for Mr. McMillan. In your testimony, you stated that Florida's largest peanut grower organization supports the current PLC programming and supports continuing it in the new Farm Bill. Now, some of my producers don't have base. They don't have generic base or any base. And so what are the potential solutions for them? And in light of, I heard you say that the peanut farmers are all unified.
This is not a problem for me, but it is a problem for those peanut producers. Those peanut producers have been growing peanuts in the past, and what I would suggest in the next Farm Bill is that we look at possibly allocating them some base based on their past cropping history. My only concern is about cost.
What kind of bases do you personally have in your farm, and how did you get those bases?
On our farm, we have peanut base. We have generic.
Maybe you have other bases. I don't know.
Yes, sir. We have generic base. We have peanut base, and we have rye and corn base. Okay. We got those bases. They were allocated to us over different farm bills, going all the way back, I think, to 1990 maybe, I'm not sure, but the different farm bills that we've had, we have been allocated those bases based on our cropping history. I think almost in every case, that's the way it was allocated. Another way that you can acquire base is if you buy a farm, the bases come with that land. And then we, in 2002, did it kind of the old-fashioned way. In 2002, we were able to buy base. We were allowed to do that, and we bought base and moved it to our farm.
Can that still be purchased, base?
No, sir. I don't.
I actually didn't think it was. I just wanted to check with you. Let me, in the interest of time, let me ask a different. Mr. Roney, are foreign countries now cutting back on their subsidies and their programs for their sugar producers?
No, sir, they are not, and thank you for asking. There has been a sense that globally we're moving more toward free trade, but that certainly has not been the case in the sugar industry. Because of the volatility in the world sugar market, and we had prices half of what they are now just a couple of years ago. Countries are getting more aggressive about subsidizing, and we've had work done that has showed Brazil, the biggest exporter in the world, is subsidizing to the tune of $2 to $3 billion per year. Thailand, the second biggest producer, is subsidizing for just under $2 billion a year. India, the second biggest sugarcane producer, is subsidizing $1 to $2 billion per year. So unfortunately, it's getting worse. We seem to be moving further from free trade in sugar than closer to it. And that makes it all the more important that we sustain U.S. sugar policy as a response to those foreign subsidies.
Well, thank you for that also, Mr. Rooney. So some sugar containing product manufacturers, people, candy, et cetera, they claim that U.S. sugar prices are costing them jobs, and consumers would benefit if the sugar prices were lower. Do you see that as true? And if not, can you explain that?
Certainly not, Congressman. When you look at sugar-containing product manufacturers, that is one of the strongest sectors of the economy financially. They've grown about 30% in the last 10 years or so. They have shed a few jobs in that process, but if production is rising and they're reducing the number of jobs, that's because of automation, mechanization. That's all there is. If you look at a candy bar that in 1985 cost 35 cents, it had about 3 cents worth of sugar in it. You look at a candy bar this year that costs $1.49, it has about 3 cents worth of sugar in it. So number one, the cost of the sugar is minor in their overall cost for producing that product. And number two, what they're paying for that sugar has stayed incredibly stable over the last 30 years. If we gave them the sugar for free, I don't think you'd see a candy bar price go down in the slightest.
Thank you for that clarification, Mr. Chairman. I yield back.
I thank the gentleman. Recognize the gentleman from Florida, Mr. Lawson, for 5 minutes.
Okay, thank you very much. And my question was centered around Cuba. You know, can you talk about the importance of creating trade market with Cuba regarding the rice industry? Can you elaborate on the potential increase to U.S. rice industry in dealing with Cuba? I really have some concerns about that because of this new market that's supposed to be opened up. Mr. Gerard.
Yes, sir. Yes, sir. At one time, Cuba was our #1 export destination for U.S.-grown rice. They're very close proximity, as you well know, to the United States, and it's a natural market for USA rice, and I believe we would see a significant increase in demand rather rapidly if trade were opened.
Okay. I have a question for sugar. Mr. Rooney, sugar policy opponents claim that they want to modify the sugar policy and not repeal it. With changes they are calling for, such as means testing, operating loans for sugar processors, penalize sugar farmers?
Thank you, Mr. Larson, for that question. What is vexing for us is that when our opponents say that they just want to do some minor modifications to sugar policy and not repeal it, in fact, they've suggested would rip the safety net out from under our producers. A study done by the Agricultural and Food Policy Center at Texas A&M, Professor Outlaw, looked at that carefully and decided that looking just at what the sugar policy opponents are proposing, said it would pull out the safety net, it would put a lot of U.S. producers out of business. And ironically, he said that would be a bad practice for consumers in general and for these food manufacturers because they would have fewer sources of domestically produced sugar for their operations. So that's why we really prefer to sustain sugar policy in its current form and maintain a strong safety net as the policy was designed in the last Farm Bill.
Okay, and the other question I have is, in Florida, there's been considerable amount of elaboration between sugar and the environmental industry, especially as it relates to the Everglades in Florida, having a balance there in terms of the importance of the water supply, for South Florida. And it always comes up in an issue. And I wanted to know from the industry standpoint, how do you feel that the water management districts in those areas have been balancing the relationship between the sugar industry and the protection of the Everglades?
Yes, sir, that is a difficult problem, and within that problem is that so many of the proponents for the Everglades are really scapegoating sugar. There are millions of people living around that area. There are many other operations, ranching and so on, and vegetable operations. And sugar tends to be scapegoated. But the sugar farmers in Florida have really been using their best cultural practices and have far exceeded the goals or the targets that were given to them to reduce phosphorus and other runoff. So I'm optimistic that we can find a balance there and not have to shut down a very efficient and important sugar industry in that area that is, in some rural areas around the Everglades, is virtually the only job provider, and work out a balance. I think that the sugar producers are very keen on being good stewards of the land and maintaining clean water and clean environment, and I think they're fully capable of continuing to achieve that.
Okay, thank you. I yield back, Mr. Chairman.
Gentleman yields. Pleased to recognize the full committee chairman, Mr. Conaway. Did you not want? Okay. And Mr. Arrington is recognized for 5 minutes from Texas.
Thank you, Mr. Chairman, and thank you, panelists. Mr. Lee, good to see you. Enjoyed speaking with you out in my district. You guys know, and I know Mr. Lee does, that I represent the largest cotton producing district in the country. And West Texas and cotton are synonymous. Cotton is king. Cotton is life. And we're in a real crisis. It's a real disaster. And if we let it continue much longer, it will fundamentally alter our economic landscape. And I imagine that there are a lot of rural communities in the Cotton Belt that are similarly situated. And so I come with grave concerns and with a sense of urgency with respect to our cotton producers. One of our first hearings, I asked an ag economist, a policy expert, could the rationale that was applied by the WTO in the Brazilian case be applied to other commodities? And the answer was, yes, it could. So my question to you is, what would America look like? How would we be positioned economically and from a national security perspective if we pulled all of the commodities out of Title I? Do you agree with me it would be an epic national security crisis? Just yes, no?
Yes.
Yes, sir.
Yeah. So are you
Definitely.
concerned? Are you all concerned that the next commodity to be pulled out of the Title I on account of WTO or some complaint from another country, maybe Brazil, maybe India, maybe China, that will result in your commodity being pulled out of the safety net that protects your commodity and your farmers from market volatility?
Yes.
So I'm very concerned, and I'd like Mr. Lee, if you would just expound a little bit on the seriousness of this crisis, the sense of urgency, and its effect on the broader ecosystem in the Cotton Belt.
Well, cotton was singled out, as you say, and we started a long time ago, and we gave up different programs along the way. But then in 2014, we gave it all up, I guess, for stacks. But I'm right there with you. I think I've been to your area, and you and I've, but you only got cotton, basically. We do have other crops, and so therefore, peanuts for one, corn. If any one of those was singled out, it would be tough.
Yeah.
And really tough.
Mr. Lee, I want to implore my colleagues.
Survive it all.
I want to implore my colleagues, please help us get cotton back in the Farm Bill. Please help us get cotton back as a Title I covered commodity. It's the only commodity that's not in the Farm Bill, and we are sucking air. Ag is sick. The farmer is in the hospital. Cotton is in the ICU. Help. And I don't know how much time we have. So let's talk about China. I appreciate Mr. O'Halloran's perspective and thoughts and comments about market manipulation by countries. It's my understanding that China is the #1 cotton-producing nation in the world. Is that correct?
I think India is now.
Okay, well, they're 1 and 2.
China's right there with them.
Okay, well, they're top 2. So it's my understanding also that China is designated as a developing nation according to the World Trade Organization, which allows them to subsidize their cotton farmers, much like we support our farmers, maybe even more so, but is that true?
That's right. They're subsidizing their growers twice the price of polyester for their cotton. And as I said earlier, we're having to compete with China and India on the polyester, a man-made fiber. So,
Mr. McMillan, my understanding also, because I represent peanut growers, and we've had a mass migration of cotton farmers to the peanut production side, and that has had a negative effect on the price. And so my question to you is, has there been a ripple effect and an adverse impact on the peanut growers on account of cotton being taken out of the Farm Bill?
There's no doubt we need a companion crop with peanuts, and cotton is something that we grow very well with peanuts for rotation. But right now, the peanut demand and supply is in balance, right where we should be. So we've probably had some increase in acreage of peanuts because of cotton. And anytime supply dictates price. But right now with peanuts, we're in a good situation.
I yield back, Mr. Chairman. Thank you.
Gentleman yields. Recognize the gentleman from Georgia, Mr. Allen, for 5 minutes.
Thank you, Mr. Chairman, and thank you, distinguished panel, for coming and talking about, I guess, all this depressing news that we're dealing with as far as commodity prices and that sort of thing. I believe we can all agree that trade and expanding markets are vitally important to the agriculture industry and our products, and we've already touched on the issues in China. You know, my shirt's made of cotton, which probably most everybody in here is wearing a shirt made of cotton, and it probably came from somewhere in you know, near China or Asia, but. You know, we're the big consumer as far as textiles are concerned. And so, and we also make the best cotton in the world. The cotton, which is mentioned, I don't know about the cotton in India, but I know the cotton in China is not as good as our cotton. So, with that in mind, as far as our trade policies are concerned, Mr. Lee, when we talk about agricultural trade issues and competition from foreign producers, what are the most challenging issues that U.S. cotton producers face globally? In other words, we've got the best cotton, we buy most of the shirts. It looks like we could figure that out and say, okay, you know, we've got an industry over here that we've got to protect. How can we do that?
Well, one thing that we've been doing is the program that's public-private that we have helped support the domestic mills, and so that they can add mills, add equipment, increase capacity, create jobs, and we need to continue to do that. As far as the cotton side, as I said earlier, we're exporting 75% of the cotton,
right?
15-20% of the textiles.
Mm-hmm.
We need to continue to really be focused on export markets. Our largest markets are.
As far as of course, we got the next farm bill coming up. Cotton's not protected in this farm bill, and we talked about the cotton. You mentioned the cottonseed issue in your testimony. Can we get to the next farm bill without some help here, or, I mean, what do you, I mean, we had the commodity folks in here, and they said, you know, the good news is we don't think prices are going down, but the bad news, we don't think prices are going up. So how do we get cotton to the next Farm Bill?
Well, first of all, the council's program or plan is a good plan to get there. My first comment I want to make in what you just said, though, is that if we wait till the next Farm Bill, us to grow cotton, we won't get any kind of support until the fall of 2020. So we got to, if we don't get something to bridge us to get to the table of the Farm Bill,
Bottom line, something has to be done.
we won't have anything.
Okay, immediately, okay. And as far as peanuts, Mr. McMillan, you know, you had mentioned in your testimony that you used the PLC program versus the ARC program. Why did you choose the PLC program for participation versus the ARC program?
I tried to study both of those programs before I signed up, and the reason I chose the PLC program is because I was familiar with it. It was very similar to the 2008 Farm Bill. And then we had our land-grant universities who are doing research and trying to figure out what would be best for Georgia farmers, and they were leaning us towards PLC for peanuts.
And do you believe that the success of PLC, you know, for peanut producers, that we're okay there as far as the future is concerned with folks going to that program?
Yes, sir. The PLC program is what we need for peanuts.
Okay. All right. Well, my time has expired. I yield back. Thank you so much.
The gentleman yields back. Recognize the full committee chairman, Mr. Conaway.
Well, thank you, Chairman. Again, gentlemen, thank you for being here today. Appreciate it. You've all highlighted just a couple of things that we got to get done in the next Farm Bill. Communication is a big deal, obviously, and so help us understand the impact that these last 3 or 4 years have had on you. And with respect to the 14 Farm Bill was done against a backdrop that things were good enough in agriculture that people actually asked, do we really need a safety net for production agriculture because prices are never going to go down? Well, here we are, 2017, 18 is not anticipated to be any better. Could you share with us better ways than we've currently been saying it, the impact that has and why we need a Farm Bill, why you need these programs, and telling your own story in the sense that the American consumer enjoys the safest, most abundant, and affordable food and fiber supply in the world. And you know, while obviously producers are in favor of a Farm Bill, SNAP folks are in favor of a Farm Bill, why wouldn't anybody who eats in America be in favor of a Farm Bill that delivers them that deal? They go to the grocery store, they get a deal, and they don't know it, and they certainly don't know why they're getting a deal on their food. And the restaurants the same way. And so, help us understand the impact that the differential between the 14 backdrop and the 18 Farm Bill is, and why it's so important that we have this Farm Bill. So, any thoughts you've got in making that happen, please start doing that. I'm going to deputize each one of you to be a part of that messaging system that tries to convince that monster group out there of those of us who like to eat why it's in our best advantage to keeping you guys in business. So any thoughts you have on how we distinguish between what was going on in 14 and versus 18 that would help us in our communications with our constituents back home as to why this program does in fact work? Anybody on the panel? And then think about that moving forward as you do your jobs.
I'll start by saying that I think we got the best story to tell, but we're not able to get it out there. You know, the consumers just don't get it. That the subsidies that we get pass through us to the consumer to have cheap food and cheap fiber, and that's a hard message to get out there. But that's the way I see it.
in our case, the PLC program is working for rice the way it was designed. I mentioned a few tweaks we can do. But in defense of this, all of these commodities are simply cannot compete with foreign government subsidies. And there's producers all over the world that are producing for a subsidy, they're overproducing as a result of these lucrative subsidies. They're encouraged to plant crops when the market tells them otherwise. That distorts the world price of commodities and results cost the American taxpayer money.
The PLC program is also working very well for peanuts, and it's what's really keeping us in our part of the world in business right now. But to answer your question about the farm bills, it not only affects the farmers and keeps them in business, but it keeps your car dealers in town, your restaurants in town. It goes out into the rest of that community. So these farm bills are so important, and without those safety nets, I don't think we can stay in business.
As you alluded, at one time we thought, well, there was the new paradigm. We don't have to worry about these things, right? Most growers, even a lot of growers, felt the same way, that do we need this anymore? And I think the growers themselves have, of course, seen the light blaringly in the last 2 years, 3 years. And the trouble is getting that across to the general public as to how essential these things are. And there are still organizations and groups of people that are saying, no, it's not needed anymore, and I definitely strongly disagree with them, and will do everything I can to get that word out.
Mr. Chairman, I've had the privilege of working for American farmers in this town for 40 years, and I've been incredibly proud of that, and I've been discouraged at times to see how much the society in general takes agriculture for granted, that we have a wonderful, safe, cheap food supply, and they don't realize what it takes to produce that, how proud we are that we are efficient by world standards, all American farmers, while adhering to some of the highest standards in the world for defending workers and consumers and the environment. And so I would hate to see consumers get a rude awakening if we gave up our sugar policy, our agricultural policies, let our farmers go out of business and became more dependent on foreign food. I think it would be less dependable, it would be lower in quality, it would be, in all likelihood, less safe, and I'm sure we'd have more volatile pricing than we have now. So I think you're absolutely right. We do have a major message to continue. It's been a battle. I've been witnessing it for decades. But to get across to the American people how good we are at what we do in American agriculture and how important it is that we have the ability to stay in business and not be put out of business by foreign subsidized producers.
Well, if the chairman would indulge me for a couple of seconds. Well, thank you again, Ronnie. You've got a great story to tell. You just have to tell it over and over and over and over till you're sick of telling it, and then you got to tell it a couple more times to make sure that you get your point across. Something that I discovered recently from Bart Fisher, my economist. If you divided the economic ladder in this country into fifths, the top 20% of the economic ladder, those folks spend more on food. Think about that. They spend more on food than the bottom 20% makes. So as we look at the 18 Farm Bill, what I am decidedly uninterested in is arbitrarily, capriciously raising the cost of food to the bottom 20%. The top 50%, they don't care what food costs. You can add a couple of $1,000 a year to their food bill, and they're not going to notice it. But that bottom 50% will, in fact, notice it. You can like the current foreign policy, or you can hate the current foreign policy, but it delivers the most affordable food supply of any other developed nation in the world. And so as we craft these policies and look at the impact it's going to have, the family I'm going to have in front of my mind is that single mom struggling to make ends meet. Her food budget is where she flexes. Her car payment doesn't change and her rent payment doesn't change, but her food budget is where she flexes. If something unexpected comes up in the middle of the month, it comes out of her food budget. I am not interested in making her life any tougher by simply raising the cost of food. And so that's going to be the fight we're going to have. I got to have you at the table fighting because you've got the best story to tell, and you're, quite frankly, the best people to tell it. But the American consumer gets a deal, a really good deal, when they go to the restaurant or when they go to the grocery store. That bottom 25% spends 35% of their disposable income on food. We're not going to raise the cost of food just because we can't. I just shouldn't do that. And so as we start this path together, I need you guys, all of you, the commodities that are at the table today, the ones last week, and the folks who weren't at the table, do the family fight, do all the arm wrestling we need to do before we get there. But once this thing starts forward, you got to go shoulder to shoulder with us to make it happen. So please the indulgence of the chairman. With that, I yield back.
I thank the chairman, and I would just like to add, there's some recurring themes here, and I don't know if it was Mr. Lee that pointed this out, but it has come up before, and I think it's important to note that farmers are essentially pass-through entities, and the real beneficiary, as the chairman indicated, is the American consumer. And so weaving that into your story can go an awful long way to help people recognize the value proposition of why we do what we do here from a standpoint of foreign policy. I'd also like to say that we can only control what we do here in the United States. We can't control what other countries do, and so our policy is a response to what's going on in the global marketplace. I dare say there's not a member in this body that would love to get, and you would probably feel the same way, that you would love to get to a point when we don't have to debate foreign policy because it's not necessary anymore. But we can only control what we do. And it's a direct response to what's going on in the rest of the world, as most of you have indicated, whether it be sugar or whether it's cotton in China and India, whether it's the Cuban marketplace, as Mr. Lawson indicated. So our job here is to create a response to the circumstances that are dictated to us in the global marketplace. And at some point in time, maybe we'll get to a point where we don't have to have these conversations anymore. But until that time, I appreciate the fact that you have taken your time to come here and share your story with us and be partners with us in doing the best we can to make sure that we do continue to enjoy the safest and most abundant and most affordable food supply on the planet. Thank you all for being here. Under the rules of committee, the record of today's hearing will remain open for 10 calendar days to receive additional material and supplementary written responses from the witness to any question posed by a member. This hearing of the Subcommittee on General Farm Commodities and Risk Management is adjourned.